In market news now, the rand firmed in early trade as the dollar fell sharply on expectations that the largest U.S. bank failure since the 2008 financial crisis would prompt the Federal Reserve to slow the pace of its interest rate hikes. Meanwhile, locally mobile network operator MTN lowered the medium-term profit margin target for its South African business due to crippling power outages that have inflated its operating costs, sending its shares down 6%. Meanwhile, clothing retailer TFG Africa, owner of Markham's, Choreographed, Jet, Fabiani and the Fix brands, amongst others, has predicted it lost 1 billion rand in revenue due to load shedding in its year-to-end March. However, to talk to us about the latest when it comes to the markets, we are joined by Patrice Rousseau, who is the Chief Investment Officer at Ashburton. Patrice, let's start with things locally before we move stateside. As I mentioned in my intro, we had the likes of MTN, ABSA and Sun International reporting earnings. Which of those company results caught your attention?
Good afternoon, Anastasia, and to your viewers. Yes, a very early start to the trading week with the companies reporting results not really helping their own cause, with some quite negative, I would say, outlook statements. So I think, just in context, I think the whole market is still quite concerned about the after effects of the banking failures overseas. So if we talk about banking in terms of ABSA, I think the results were well telegraphed, but the focus remains on their credit losses in Ghana, which drove the whole credit loss expense to increase by over 60%. That said, they still posted earnings just below 14% growth, although it is below what the peer group has just reported if you look at Nedbank, Standard Bank, and First Rand. So that has put the share price under a little bit of pressure. That said, they're still guiding to their cost to income coming lower over the next year, and returns increasing towards their target of 17%. But the market doesn't want to hear about this. The market really focusing on the broader picture where banks globally have come under quite a bit of pressure.
Right. So let's talk about those banks. I mean, we were talking about Silicon Valley Bank on Friday, and this one caused by a run on the bank. And I mean, perhaps let's give some context for viewers in terms of your understanding of this situation. Was this an unforced, self-inflicted error when it comes to what the company was trying to do when it comes to selling the bonds or fundraising?
Yes, that's a very good question, Anastasia. SVB Group, who own Silicon Valley Bank, most people wouldn't have heard about them. They're the 16th biggest bank in the U.S. before last week. Obviously, they've now collapsed and gone bankrupt. Really a bank which was lending to venture capitalists, basically to entrepreneurs who were investing in many tech. But interestingly enough, their depositors also counted quite a few of the same type of clients in the tech industry. So these investments started to basically decline with the general sell-off in tech stocks, and the bank seemed to found itself in a bit of a liquidity trap and decided to realize $20 billion of its bond portfolio. Bonds had been under pressure, which meant that it would have suffered a loss of around $2 billion, and decided to go to the market to raise equity. But word got out, and before they were able to execute on their share placing last week, basically we had a run on the bank where depositors started withdrawing money at a faster pace that they could repay. So a lot of it is self-inflicted. A lot of it was about the news leaking out before they were able to take action. But it's also, one has to look at the broader context. It's a bank which was lending and at a massive growth to these tech entrepreneurs, which looks like it's not something that they would be able to realize. So it's a bit of liquidity matching which went amiss in this bank, and bad banking practices.
I'm sure in the next few weeks or coming months, we'll have a detailed post-mortem in terms of what actually happened and whether this bank was actually under a significant duress long before these actual bond sales started. What questions does it raise for you then when it comes to the other U.S. banks?
I think the key questions is regulators are meant to stress test the balance sheet of these banks. And it looks like there are a number of medium-sized banks in the US which haven't been scrutinized properly by the regulators. The big banks, what they call the money center banks, are always very well regulated. They're well diversified, they've got access to liquidity. It's these second-tier banks which haven't been well scrutinized. I think the question mark comes from banks which have got illiquid assets on the one side and also are not retail funded, where you have big concentration of depositors that allows for a run on the banks, and also the type of world we live in. Through social media, once the noise started to dissipate, everyone got to hear about it, and you almost had overnight this run of the bank. Not people queuing outside of branches, but people just trying to transfer money out of the bank. So it's a different type of bank run that we've experienced.
So events you're going to be keeping an eye on going into the remainder of the week on the back of the jobs report figure that we got on Friday.
Yes, the jobs report figure, 311,000 jobs, well above the consensus of 225,000. So that would, in normal circumstance, be an indicator to say that the U.S. economy is running quite hot, and the Fed should be hiking well above 25 basis points, maybe 50. But that's cold water has been poured over this, because now the kind of sentiment is financial conditions are too high, are too tight, and that the financial sector is under pressure, and maybe the Federal Reserve shouldn't hike at all. So markets are now expecting the Fed not to hike at all. I think that's quite an extreme. I still think their focus is on inflation. Maybe they'll do 25 basis points, not 50 basis points. But markets it's really a topsy-turvy change in sentiment by markets, going from being expecting the Fed to over-tighten to now expecting the Fed not to tighten anymore.
Perhaps you can help me with this one. The lag effects of monetary policy, when do I start to see them?
Yeah, I mean, it's a good question. I think you only see monetary policy biting about 9 months after you see the first rate hikes. And if you think of the US, for instance, the hiking cycle started last year, basically a year ago. And now only as we've had these numerous hikes, we're starting to see the impact on the economy, on the financial system. So on cue, as I said, 9 to 12 months, this is where now we're starting to see the negative impact on asset prices,
right,
of tighter financial conditions.
Patrice, let's leave it there. Thank you so much for your time. That is Patrice Rousseau, who is the Chief Investment Officer at Ashburton Investments. We're going to take a quick break. When we come back, we'll find out what's happening from ABSA, and then we'll catch up with Sun International. Stay tuned.